For the last 20 years, the golden rule of personal finance has been incredibly simple. Just buy the index and chill. The logic was that if you bought the S&P 500, you were betting on the entire American economy. It was the ultimate set it and forget it strategy. But in 2026, that advice has become a dangerous oversimplification. The index is no longer the broad safety net it used to be. It has morphed into a highly concentrated bet on just 7 massive companies. If you are 45 years old, this shift matters immensely. A lost decade of flat returns right now doesn't just mean your account grows slower than you hoped. It means pushing your retirement date from age 55 back to age 65. Welcome to the channel. I'm Mr. Greenvestor. We aren't here for hype or fear-mongering. We are here for the math. Today, we are breaking down the new reality of concentration risk and sequence of returns so you can protect your wealth. The concentration trap, why the index is top-heavy. To understand the risk, you have to look at the structure of the S&P 500. Most people assume the index is like a diversified mutual fund where every company pulls its own weight. Think of it instead like a massive skyscraper supported by 500 pillars. You naturally assume every pillar carries an equal share of the load. But that is not how market cap weighting works. In 2026, just 7 of those pillars are carrying nearly 40% of the entire building's weight. If those 7 pillars show even a tiny crack, the whole building shakes. Regardless of how strong the other 493 pillars are, the data confirms this structural weakness. As of late 2025, the top 10 companies make up nearly 39% of the entire index. To put that in perspective, that is significantly higher than the concentration we saw during the peak of the 1999 tech bubble. When you buy an S&P 500 index fund today, you think you are diversifying across the entire U.S. economy. You aren't. You are effectively running a sector-specific technology fund disguised as a broad index. You are betting your entire retirement on the performance of the Magnificent Seven. If tech takes a hit, your safe index fund takes a hit right along with it. The problem isn't just the concentration, it is the price you are paying for it. Right now, the price-to-earnings ratio for the index is hovering near 30. And the cyclically adjusted PE ratio, or CAPE ratio, is sitting around 39. These numbers might just sound like abstract jargon, so let's use a simpler analogy. Buying the index today is like buying a house at the absolute peak of a bidding war. The house itself is high quality. It has a great foundation and a good roof. But the price you pay determines your profit margin. If you overpay by 50% because of a bidding war, the house is still good, but it destroys your future returns. You have to wait years just to break even on the price you paid. History tells us exactly what happens next in these environments. When the CAPE ratio hits these elevated levels, the subsequent 10-year annualized returns drop significantly. Everyone expects the historical average of 10%. But historical data suggests that from these valuation levels, returns are closer to 2.3%. That is a massive gap. If your portfolio stays flat for a decade while you are working, it is annoying. But if it stays flat while you are trying to retire, it is catastrophic. The danger isn't just low growth. The danger is what happens when you try to withdraw money to pay your bills from a portfolio that isn't growing. The danger isn't just that the market might stay flat. The danger is the specific timing of when those flat or negative returns occur. This is what financial planners call sequence of returns risk, and it is the single biggest threat to your retirement security in 2026. To understand why, you have to stop thinking like a saver and start thinking like a spender. When you are saving, a market crash is actually a good thing because you are buying shares on sale. But the moment you retire and start withdrawing, the math flips upside down. The silent killer, sequence of returns, and the 3.9% rule. Think of your retirement portfolio like an airplane's fuel tank. You have calculated exactly how much fuel you need to cross the ocean. Sequence of returns risk is like hitting a massive, sustained headwind immediately after takeoff. You are forced to burn through your fuel, your capital, at double the normal rate just to maintain altitude. Even if the wind dies down later in the flight, it doesn't matter. You burned too much fuel early on, and now you mathematically cannot reach the runway. In financial terms, if the market crashes 20% in your first year of retirement and you are still withdrawing money to pay bills, you are forced to sell more shares at depressed prices. You are cannibalizing the very engine that is supposed to generate your future growth. This is why the old rules no longer apply. For decades, the standard advice was the 4% rule. Withdraw 4% of your portfolio in year one and adjust for inflation. But given the high valuations we just discussed, that rule is outdated. Morningstar's 2026 research update has lowered the safe withdrawal rate to 3.9%. That might sound like a tiny adjustment, but over a 30-year retirement, that tenth of a percentage point represents a significant reduction in your lifestyle. The research indicates that with P/E ratios this high and inflation expectations lingering, a rigid 4% withdrawal rate creates a high probability that you will run out of money before you run out of life. Let's look at a practical case study to see how this plays out. Imagine two portfolios entering a 10-year flat market. Portfolio A is the standard buy and chill strategy, 100% invested in the S&P 500. Portfolio B is a diversified mix. In year one, the market drops 20%. The owner of Portfolio A panics but still needs $40,000 for living expenses. Because their account value has dropped, they have to liquidate a larger percentage of their total holdings to get that same $40,000. By selling at the bottom, they lock in those losses permanently. Even if the market roars back the next year, that money is gone. It cannot grow. It cannot compound. This is the sequence of withdrawals reality. A loss early in retirement is mathematically devastating because you have no time to recover and no new income to replenish the tank. This mathematical reality is compounded by the retirement spending smile. Research shows that real-world spending is not a flat line. It tends to be higher in the early years of retirement, the go-go years when you are healthy and traveling, and higher again in the final years due to health care. It dips in the middle. If a market crash forces you to slash your spending during those first 5 vital years, you aren't just losing money. You are losing the experiences you worked 40 years to afford. It is easy to hold 100% stocks when you are adding money from your paycheck every 2 weeks. It is a terrifying psychological game when you are selling shares to buy groceries during a recession. The goal, therefore, is not to abandon growth, but to create a system that allows you to ignore the crash completely. The solution: a bucket strategy for the 45-year-old. The antidote to sequence of returns risk is not timing the market. It is time segmentation. We call this the bucket strategy. Instead of viewing your wealth as one big pile of money that needs to do everything at once, we divide it into 3 distinct buckets based on when you need to spend the money. This strategy gives you the psychological and mathematical runway to survive a lost decade without sacrificing your standard of living. Bucket 1 is your volatility shield. This bucket holds 1 to 2 years of living expenses in pure liquid assets, cash, money market funds, and treasury bills. The goal of this bucket is not growth. The goal is sleep. If the S&P 500 drops 30% tomorrow, it does not matter to your daily life because your mortgage and grocery bills are paid from this bucket. You never have to sell a single share of stock at a loss to keep the lights on. You simply spend down your cash reserves. Bucket 2 is the bridge. This is where we place the next 5 to 7 years of your living expenses. We invest this money in high-quality fixed income and bonds. For a long time, bonds were considered dead money because interest rates were near zero. But in 2026, the math has changed. With yields hovering around 5%, this bucket now carries its own weight. It generates consistent income while preserving your principal. This bridge connects your immediate cash needs to your long-term future, ensuring that you have a reliable paycheck coming in, regardless of what the stock market is doing. Bucket 3 is the growth engine. This contains your remaining assets, and this is where we keep the S&P 500. This is money you will not touch for at least 10 years, because you have a 7 to 10-year runway of cash and bonds in buckets 1 and 2. You can afford to let this money sit. If the market crashes, you don't panic. You wait. You have time to let the market recover, cycle through the downturn, and return to new highs. By the time you need to tap into bucket 3, the lost decade will likely be over, and your growth assets will have had time to compound. For a 45-year-old, this structure changes everything. It creates a 7 to 10-year buffer where the stock market can do absolutely anything, crash, stagnate, or boom, and your lifestyle remains unaffected. You are no longer watching CNBC hoping for a rally. You are living your life knowing your bills are covered. This system gives you permission to spend. When you see that your next 5 years are fully funded in buckets 1 and 2, the fear of the daily ticker tape vanishes. You have effectively engineered the anxiety out of your financial plan. You have separated your security from the market's volatility. The S&P 500 remains a powerful tool for long-term growth, but at these specific valuations, it is a dangerous tool for short-term security. Please don't bet the farm on tech. Check your concentration today to see if you are accidentally overexposed to the Magnificent Seven. Next, go run a sequence risk simulation on your specific numbers. Finally, download the free bucket strategy template linked below to visualize your own volatility shield. Remember, this video is for educational purposes only. Past performance does not guarantee future results. Take one small step today to secure your future. See you in the next breakdown.